Hello and welcome back to Underdog Investing. So today I want to talk about 3 reasons why I think Lemonade Insurance is going to disrupt other insurance companies. And by that I mean old school insurance companies such as Geico, Allstate and State Farm. Before I dive into the video, I'll be very grateful if you can like the video and subscribe to the channel. Now let's start by looking at the stock price. So if you have a look here, you can see that today is the 8th of January 2021 and the stock actually finished at $160. This has actually had a very good run up in the last few days. So I did a video about a few days ago and it was around 115 and now it has gone up by about 40%. In the short term, it's very difficult to tell what the stock's going to do, but in the long term, I think this company is going to do very well in terms of the share price. So moving back to the video, 3 reasons why Lemonade will disrupt insurance. The first one is behavioral economics. Now, if we compare old school insurance versus Lemonade, with old school insurance, it's a win-lose relationship with customers. So what I mean by that, so if the customer makes a claim and the claim is denied, the insurance company wins and the customer loses. Because when the claim is denied, the money goes into the insurance company's pocket. Whereas if a claim is paid, the customer wins because the money goes into the customer's pocket and it comes out of the insurance company's pocket. With a model like Lemonade, it's a win-win relationship with customers. The reason why I say that is because the way Lemonade works is when they take a premium from a policy, they take a flat fee, and this fee at the moment is around 25% from what I remember. The rest of the money goes to paying claims, and whatever's left over at the end is basically going to go to a charity that the customer specifically picked personally. So when a claim is denied, so when a customer makes a claim and the claim is denied, the customer doesn't actually lose because the money actually goes to the charity that the customer picked. This is very good for the insurance company as well, because now the insurance company doesn't have an incentive to deny claims because they don't actually benefit from denying any claims, and this removes the conflicts of interest. When a claim is paid, the customer wins and they're happy. The insurance company also wins because number 1, they've delighted the customer, and number 2, they've removed this conflict of interest. The next one is artificial intelligence. Now, an old insurance company, when they make a policy, what happens is they collect data, but very little amounts of data. They collect 30 data points. And by data points, I mean things like your age, for example, what address that you live in, and these kind of things. Now, Lemonade Insurance collects 1,700 data points on average per policy. That's much higher than the old insurance companies. Now, if you have a look at the graph down below, you can see that the amount of data that Lemonade Insurance collects is actually exponentially higher than the old insurance, especially over time. Over time, that the difference actually diverges and it doesn't converge. Now, the reason why this is good is because insurance is basically, the business of insurance is risk management, and the more data that you can collect, the lower the risk is going to be, because you can actually increase the premiums for customers who you think are high risk, and then you can reduce the cost of premiums for customers you think are low risk. So you're collecting more data, you're actually reducing more risk, and that allows you to grow your business quicker. When you grow your business quicker and you're actually able then to collect more data, and that creates a positive feedback loop. And finally, the ability to expand. Starting with old insurance companies. Let's say, for example, it's an insurance company which is based in the USA and it wants to move into the European market. Now, if you look here in the USA, let's say they've got hundreds of millions in buildings, and they've also got tens of thousands of employees, which they basically need to run the business. Now, when these companies want to move to different markets, especially when it's overseas, this is what they need to do. Let me just show you. They actually need to they actually need to hire around 10,000 employees and spend hundreds of millions on another massive building to put the employees in. Now that's a lot of money and a lot of effort. So usually insurance companies don't tend to move across borders. So that's one of the reasons why. If we look at Lemonade Insurance, so if they wanted to do the same thing, for example, go from USA to Europe, what do they need to do? Well, first of all, they don't have many employees, which is actually a positive. And the crazy thing about it is when they want to move to Europe, they don't actually need to do anything. Just to give you an example, they've moved their business from USA to France. And the amount of employees they have in France is 0 employees. They've also moved their business from the USA to Germany. And the amount of employees they have in Germany is 0. Now, I find this point just amazing, and it's just mind-boggling. So in summary, the 3 main things is Lemonade does not have a conflict of interest. Lemonade collects way more data, and they're also able to expand just in crazy ways that old insurance companies aren't able to. So these are the reasons why I think Lemonade is going to disrupt the insurance business. So that's the end of the video. If you enjoyed it, I'll be grateful if you can like and subscribe to the channel. And I'd love to hear your thoughts in the comments down below. And if you found it useful in any way, I'll be grateful if you can share it. Thank you very much for listening, and I look forward to making another video.